Welcome to our Q2 23 M&A Market Outlook. I'm Ian Swarshott with the latest developments in M&A. So what's been going on in the M&A market? In terms of current activity, there's interest in M&A from buyers and sellers. There's also large amounts of capital ready to be deployed, but bid-offer spreads remain too wide. Inflationary costs are challenging operating models. Debt availability and debt costs have increased return hurdles. Private credit funds have also been affected, especially when it comes to raising new funds. This has impacted the appetite for deployments. These factors have significantly dented current M&A activity levels when compared to the high points experienced post-COVID. Now let's compare deal activity levels of Q1 23 versus Q1 22. Global deal volumes fell by around 20%. Financial services experienced the biggest drop-off in deal volumes at more than a 30% decline. We saw consumer, healthcare and TMT deal volumes drop at rates close to the global average of around 20%. Although the energy resources and industrials sector was the least impacted, it still experienced a decline and fell by 10%. The UK M&A market fared worse than the global average, due to UK growth forecasts being lower than other major European and global economies. This meant investors kept their powder dry or looked for opportunities in other markets where the economic outlook was stronger. UK M&A deal volumes were more impacted compared to the global trends, seeing volumes down 30%. We saw all UK industries experience a significant slowdown. Now onto the outlook for M&A activity for Q2 23 and beyond. The market's far from closed for the rest of the year, but sellers must recognise that values achieved yesterday are not the values today. Buyers must get comfortable with lower IRRs, and deals having to be done on an all-equity basis will cap the overall size of possible deals. Our market discussions believe M&A activity will pick up at the start of Q3. There's also sentiment suggesting this will be a strong pickup due to pent-up sellers and buyers who are eager to catch up on deals. We're also seeing the first cautious signs of market activity returning. While recent inflation figures have bucked the expected trend for a rapid decrease this year, the market consensus is that the cost of living pressures will ease in 2023, with lower gas and energy prices being a key component. Recent challenges in the banking sector have also dampened market expectations for peak interest rates. That's why markets are still pricing a significant reduction in rates for the next 12 to 18 months. We expect this to normalise at around 3%. While private credit's been more cautious, there's still lots of dry powder, which means there's no shortage of liquidity in the system. All these factors point to improving market conditions in 2023. We foresee high levels of M&A activity in three areas. First, in P2Ps with investors taking advantage of depressed market valuations. Next, the decarbonisation agenda and energy transition could create a once-in-a-generation level of M&A activity. Finally, assets helping digitalised sectors will remain super attractive to investors across all segments. However, we believe buyers will target resilient business models, as the past few years have shown us that macro events can appear out of nowhere. That's it for now. Thank you for watching. Please get in touch if you want to discuss your organisation's 2023 M&A agenda.